Usually when you walk into a casino and sit down at a blackjack table, the house has a mathematical edge.
Right, the built-in advantage.
Exactly. It's built right into the system. Maybe they keep a couple of cents of every dollar that gets bet over the long run. It is fundamentally a volume game.
Yeah. The house always wins eventually, but the margin on any single bet is actually quite thin. I mean, they rely entirely on the sheer scale of the operation.
Right. But I want you to imagine a casino where for every single dollar placed on the table, the house keeps over 50 cents in pure profit.
Which is completely unheard of.
It completely defies the laws of financial gravity. I mean, you'd think the players would feel cheated and just walk away, but instead, the line to get into this casino wraps around the block.
Everyone is begging to play.
Exactly. And that is exactly what we are looking at today with NVIDIA. We are synthesizing a massive stack of recent intelligence.
Right, the Q4 fiscal 2026 earnings, product launches from CEF and GTC.
Yeah, plus the deep financial data from RoboForex and Guru Focus, and a really sharp policy brief from the Council on Foreign Relations.
Because we are cutting through the endless retail height here to answer a multi-trillion-dollar question. Is this AI hardware giant still the absolute best stock to buy, or is it finally hitting its ceiling?
We're going to explore the jaw-dropping financials, the aggressive new hardware roadmap, and here's the key, the hidden vulnerabilities that could derail its momentum.
Let's start by unpacking this financial machine, because the sheer scale of their current dominance is genuinely hard to wrap your head around.
It really is. The Q4 fiscal 2026 numbers just dropped, and they are absolute record smashers.
Huge numbers.
We are talking about $68.1 billion in revenue for a single quarter. That's up 73% year over year. Total fiscal year revenue just crossed $215.9 billion.
But to understand that growth, you really have to isolate the engine. Data center revenue alone accounted for $62.3 billion of that Q4 number.
Just staggering.
Right. That segment is the absolute core of the business right now. It's what's driving the entire thesis.
But here's where we go back to that casino analogy. Their non-GAAP gross margins are 75.2%.
Insane.
That is the house keeping the lion's share of the chips. And the market cap sits at an astronomical $4.58 trillion.
And when you see numbers like that, the instinct for retail investors is to assume it has to be a bubble.
Right.
The consensus is that it's priced for infinite perfection.
Sure, it's easy to look at a price-to-sales multiple of 30.5 and feel visually terrified. I mean, it looks wildly expensive.
It does, but look, if you analyze this like a pro, the Guru Focus data reveals a completely different story. You have to look at EV to EBITDA. Enterprise value to earnings before interest, taxes, depreciation, and amortization.
Okay, let's pause there. Why does that specific metric matter more than just slapping a multiple on their top-line sales? What does EV to EBITDA actually tell you?
Well, price to sales is a blunt instrument. It just compares the stock price to the revenue. Enterprise value, however, strips out the noise. It accounts for the company's debt and the actual cash they hold. And EBITDA looks at the raw operating profitability before the accountants start messing with depreciation schedules.
Got it.
So NVIDIA's EV to EBITDA is currently sitting at 31.35.
Okay, so a multiple of basically 31. Is that actually good or bad for a $4.5 trillion company?
Here's the contrarian edge that most of the market is missing right now. That ratio is actually 27% below its 10-year median of 42.73.
Wait, really? So by that specific historical metric, the stock is actually cheaper right now than it has been on average over the last decade.
Precisely, even at peak market cap. And the mechanism behind that is their free cash flow.
The $77 billion.
Yes, they generated $77 billion in free cash flow over the last 12 months. The crucial insight here is that the company is literally outgrowing its own massive valuation multiple.
They aren't just inflating a speculative bubble.
Exactly. They are generating an ocean of cash to backfill the valuation, and they use that cash to aggressively reinvest in R&D, outspend rivals, and totally solidify their moat.
But look, if they are throwing off $77 billion in cash and maintaining 75-point gross margins, I mean, competitors have to be smelling blood in the water.
Oh, absolutely.
That kind of profit margin is a giant target on your back. Which begs the question, how do they actually defend this golden goose against market saturation?
Well, you defend it by accelerating the obsolescence of your own products. You move the battle from the balance sheet directly to the engineering lab.
The hardware roadmap.
Right. To understand their defense strategy, you have to look at their aggressive new rollout plan.
Which takes us to the GTC conference. CEO Jensen Huang stood up and boldly forecasted $1 trillion in AI chip orders through 2027.
$1 trillion. That's a massive claim.
$1 trillion in hardware. And to capture that, at CES, they launched what they're calling the Rubin platform, named after the astronomer Vera Rubin.
Right.
This includes the Vera CPU, the Rubin GPU, and the NVLink 6 switch.
And look, the performance claims here are designed to completely reset the market. I mean, Rubin delivers a 10x reduction in inference token costs.
Wow.
Yeah, 10x. And it also trains MOE mixture of experts models using 4 times fewer GPUs than the previous generation.
Hold on. A mixture of experts. Let's define that. For those not building AI models every day, what does that actually mean? It sounds like a consulting firm.
Yeah, it does. But it's actually a brilliant architectural shift in AI. See, in older models, when you ask the AI a simple question, it would light up its entire brain.
Like all the billions of parameters.
Exactly, just to give you a basic answer, which requires massive computing power. But a mixture of experts model is different. It acts more like a triage nurse.
Okay.
It takes your prompt and routes it only to a specialized subnetwork and expert that handles that specific topic. So by only activating a fraction of the brain at a time, it's vastly more efficient.
So the Rubin platform is specifically optimized to train these highly efficient models with a quarter of the hardware.
Right.
That makes total sense. But wait a minute, you mentioned the Vera CPU.
I did.
NVIDIA's entire empire, their absolute core identity, is built on GPUs, graphics processing units.
Yeah.
Taking on Intel and AMD in the central processor market feels like a massive, risky pivot. Why move off their home turf?
Because the strategy is envelopment.
It's envelopment.
Yes. They don't just want to be a component in the data center, they want to be the data center.
I see.
By building the Vera CPU, they eliminate bottlenecks between the processor and the graphics card. But they aren't stopping there. They're also launching the Grok 3 LPU, which stems from a licensing deal they made back in December.
Okay, an LPU, a language processing unit. How is that fundamentally different from the GPUs they already dominate with?
Think of a GPU as a bodybuilder. It does the heavy lifting of parallel processing required to actually train an AI model over months.
Right.
But once the model is trained, you need it to answer user questions instantly. That's called inference. An LPU is like a sprinter.
So it's built for speed.
Exactly. It is architecturally optimized purely for sequential token generation, basically spitting out the words of the AI's response with incredibly low latency.
So they are building the heavy lifters for training and the sprinters for inference. They literally want to dominate the entire computing stack from top to bottom.
That's the play. The market consensus was that NVIDIA owned the training phase, but might lose the inference market to cheaper, specialized alternatives.
Right. That was the big bear argument last year.
Exactly. But the Grok deal and the Rubin platform shut that narrative down entirely. They are making their ecosystem totally indispensable.
I mean, when you have Elon Musk going on record calling Rubin a rocket engine for AI, it really highlights the industry's absolute reliance on this specific hardware.
Yeah, and they aren't slowing down. I mean, the roadmap stretches all the way to 2028 with the upcoming Feynman architecture.
It sounds like an unstoppable juggernaut. They control the hardware, they control the software, they are locking everyone into their ecosystem.
We are.
But look, if they're locking everyone in, here's the real question nobody's asking. Who exactly is holding the key?
Right.
Because when you look at the buyer list, cracks really start to appear in the foundation.
This is where the structural tension comes in, and it's what you need to pay attention to. The debate on Wall Street has fundamentally shifted over the last 2 quarters. Nobody's asking how fast are they growing anymore.
Right. The only question that matters now is how sustainable is this growth?
Exactly.
And according to the investing.com source, there is a massive internal risk looming here. It's customer concentration. Just 2 customers make up 36% of NVIDIA's total revenue.
Which is a terrifying metric for a multi-trillion-dollar company.
Over a third of this machine relies on the budgets of just 2 buyers.
And those buyers are the hyperscalers, the massive cloud providers building the infrastructure of the internet.
Yeah.
Think Google, Meta, AWS.
But here is the kicker. Those exact same hyperscalers are actively spending billions of dollars right now to develop their own in-house AI chips.
Yep.
They desperately want to reduce their dependency on NVIDIA. So if your 2 biggest customers account for over a third of your revenue, and they are actively trying to build their own hardware to replace you, isn't that a ticking time bomb for that $1 trillion order forecast?
It creates a fascinating dynamic. Right now, the hyperscalers are trapped. They have to buy NVIDIA's Rubin and Grok chips to stay competitive in the AI race today, even as they fund their own escape routes for tomorrow.
It's basically a hostage situation where the hostages are building a getaway car.
That is exactly what it is. But look, there is another signal in the data that we simply cannot ignore: insider selling.
Yeah, the RoboForex analysis highlights some really aggressive insider selling here. Top executives, including CEO Jensen Huang and board member Mark Stevens, liquidated over $1.5 billion in shares in 2025.
Massive liquidations.
Now, to play devil's advocate, executives sell stock all the time to pay taxes, diversify their portfolios, buy a yacht, whatever. Is it really a red flag?
We have to look at the data objectively. Yes, some of those sales are automatic for tax purposes. But the analysis shows that 80 to 85% of those sales were voluntary liquidations right at peak market cap.
Wow, 85% voluntary.
Right. Furthermore, there have been zero notable insider purchases since late 2020. Let that sink in.
So the people running the company, the ones with the deepest visibility into the future pipeline, are aggressively taking their chips off the table.
Look, it doesn't necessarily mean they think the underlying business is failing. What it signals to the market is that the phase of easy, explosive, unconstrained growth is likely over.
They're cashing in.
The executives are converting caper gains into real money while the valuation multiple is at its absolute peak. They recognize that the transition from a hypergrowth anomaly to a mature, cyclical tech giant is underway.
And speaking of cyclical issues, we are already seeing resource tension within the company itself. The gaming segment, which, used to be their bread and butter, is expected to face major supply constraints in Q1 of fiscal 2027.
Because of capacity allocation.
Yeah, exactly. They're heavily prioritizing AI chips. The seams of their manufacturing capacity are starting to stretch.
That's just the reality of finite silicon fabrication. But listen, if customer concentration and insider sell-offs are the internal hurdles they have to navigate, there is a massive external risk that management cannot fully control.
Right.
And it is playing out right now on the geopolitical stage.
Yeah, so if insiders are cashing out because they see the hypergrowth ceiling approaching, what external forces are actually capping that growth?
Yeah.
Well, you don't have to look much further than the U.S. Department of Commerce. Let's talk about the new China export rules.
Because it is a fascinating tightrope.
It really is. In January 2026, the U.S. issued a new rule regarding advanced AI chips, specifically targeting the NVIDIA H200 and the AMD MI325X.
The rule allows the export of these incredibly powerful chips to China, but, and this is crucial, it enforces a volume cap. Exporters are capped at 50% of the total number of chips shipped to U.S. customers.
So let's actually do the math on that. Because the U.S. bought roughly 2 million H200 chips, this rule practically allows up to 1 million of these advanced chips to be legally sold to China.
Correct. And to put that into perspective, 1 million chips is an immense amount of compute.
It's enough to build a massive Memphis-sized data center.
Yeah.
I mean, the sources note that this influx would increase China's installed AI compute by 250% in 2026 alone.
Yeah, the scale is massive.
It feels like a total paradox. It's like trying to stop a rival country from building an air force, but telling a weapons manufacturer, you can't sell them your absolute fastest jets, but you can legally sell them 1,000 of your second fastest jets.
Right.
You're still giving them an armada. How does a rule that still allows a massive influx of compute power actually protect national security?
Well, it's a highly controversial move, and we need to look at this impartially. The Council on Foreign Relations just released a policy brief where they look at this rule purely from a strategic and regulatory angle, and they do not hold back.
You don't.
They explicitly call the policy strategically incoherent.
Strategically incoherent. Why? What is the specific flaw they are pointing out in this brief?
It comes down to compliance. The regulation requires exporters to certify Know Your Customer, or KYC, practices. The government is essentially telling NVIDIA, you can sell these chips, but you have to absolutely guarantee that the Chinese military, the PLA, doesn't use them.
Right, which sounds good on paper.
Exactly. But the CFR points out the fatal flaw here. Major Chinese buyers, like the tech giant Tencent, are already designated by the U.S. Department of Defense as Chinese military companies.
Wait, so the government is asking NVIDIA to guarantee that military-affiliated companies won't use the chips for military purposes, even though those companies are fundamentally integrated with the state.
That's the contradiction.
That sounds completely impossible to enforce.
And the CFR frames it as exactly that. A massive, practically impossible compliance headache for NVIDIA. I mean, once these chips enter a massive Chinese cloud computing ecosystem, it is virtually impossible for any hardware manufacturer sitting in California to credibly track where the compute is being routed or who is actually running workloads on their servers.
And the CFR warns this sets a dangerous precedent for the future hardware roadmap we just talked about, right?
Yes. They warn that if this 50% ratio logic holds, it could allow 2.5 million of NVIDIA's next-generation GB300 chips into China by 2027.
Wow.
The policy attempts to find a middle ground between American commercial interests and a national security. But according to the CFR's analysis, it basically fails to achieve the goals of either creating a deeply unstable, unpredictable regulatory environment for NVIDIA to try and forecast revenue against.
Okay, let's pull all of these threads together. We've covered a massive amount of ground in this deep dive. NVIDIA is undeniably a financial titan.
Without question.
We are looking at a company generating $68 billion quarters, printing massive free cash flow with 75% gross margins, and literally outgrowing its own valuation multiples.
Right.
They are rolling out truly visionary hardware like the Rubin platform and the Grok 3 LPU to envelop the entire computing ecosystem.
But the narrative of it being the unequivocal, risk-free best stock to buy is deeply complicated when you actually look under the hood.
Definitely.
The internal reliance on just two massive hyperscaler customers who are actively funding their own hardware replacements, the heavy insiders selling at the executive level, and a messy, contradictory geopolitical landscape all present severe structural risks to their forward growth.
And look, all of this matters to you, whether you actively hold NVDA in your brokerage account or not. Because right now, this single company is the engine of the global economy.
It really is.
They are dictating the pace of the AI age, they are shaping the future of international trade policy, and they are defining the physical boundaries of computing.
Listen, if you remember one thing, it's this. The transition from explosive, unconstrained growth to sustainable market dominance is the hardest phase for any technology giant to survive.
It's the ultimate test.
NVIDIA is walking a razor's edge right now between unprecedented global demand and severe structural constraints.
Which leaves us with a final thought for you to ponder as we wrap up. The sources today detail a massive trillion-dollar build-out of hardware happening right now. I mean, everyone is buying chips, the hyperscalers, the startups, entire nations.
A total land grab.
Exactly.
Right.
But what happens to the global tech economy if the AI models of tomorrow, like those highly efficient mixture of experts models, become so incredibly optimized that they no longer require constant hardware upgrades?
Right.
Will the AI factory boom eventually build itself out of a job? Because if you think back to our casino at the beginning, it doesn't matter if the house keeps 50 cents on the dollar or if the math is perfectly in their favor. Even the most profitable casino in the world eventually goes bust if the players suddenly realize they don't need to play the game anymore.